a 7% investment grade corporate bond. Is this something to consider for building a retirement income stream in the boost part of your portfolio? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So when we discuss rising long-term rates and attractive investment opportunities in our VIP investment club, one name that comes up regularly is Jefferies Financial Group, which often seems to offer some of the highest yielding investment grade new issue corporate bonds on Fidelity's platform. So it was no surprise that they took the top spot again the past 2 weeks. With this 7% triple B rated bond that is being offered on Fidelity until Friday, May 15th at 11:30 a.m. Eastern Time. It is callable though and has a maturity date in 2051, so about 25 years from now. And funny enough, the conversation started when one of our members happily announced that his older 7% Jefferies bond did not get called in April, and he now gets to hang on to it for at least another 6 months. Nonetheless, Jefferies is a name that inspires some of the liveliest discussions amongst our VIP members, which is saying something, by the way, given the already high level of member engagement on all topics from CDs and money market funds to treasuries, structured products, and beyond, which Markus and I appreciate and always enjoy being a part of course. So, with that in mind, here are the 3 topics that we'll be covering today that may help you decide for yourself whether this 7% bond from Jefferies might be something for you to have a look at. 1. How is Jefferies doing as a business? 2. Where would Jefferies fit in our Diamond NestEgg Base and Boost strategy for retirement? And 3. Would Markus and I invest in Jefferies personally? Let's dive in now, folks. How is Jefferies doing as a business? Jefferies may not be a household name for the wider population, but we have spoken about them before on our channel. So just as a quick refresher, Jefferies describes itself as the leading pure-play investment banking and capital markets firm. They're headquartered in Midtown in New York, have a balance sheet of $74 billion and 7,600 employees globally. Jefferies is listed under the ticker JEF on the New York Stock Exchange, with a market cap of a bit more than $10 billion at the time of this taping on May 12, 2026. It was founded by Boyd Jefferies in 1962 in Los Angeles, but they really took off in 2001 when Richard Handler became chairman and CEO, moved the headquarters to New York, and tried to break into the big league of finance to compete with the likes of JP Morgan, Goldman Sachs, and Morgan Stanley. And they have not been unsuccessful so far. As per Q3 2025, the latest we could find on their website, they were ranked in 6th place for advisory, ECM, equity capital markets, and DCM, debt capital markets, the core of what we generally call investment banking and capital markets, behind only the big 5 American names, which is no mean feat for a relative newcomer. The flip side, however, is that the Jefferies share price, the blue line here, has historically been very volatile. Just the last 12 months alone look like a roller coaster with ups and downs following each other almost every new quarter. In comparison, the yellow line here, the Vanguard Financials ETF, ticker VFH, that tracks the broad financial sector, is up roughly the same percentage as Jefferies over the past year, but it looks decidedly more stable. As many of you probably suspect by now from looking at the recent steep share price rise, Jefferies must have had a very good last quarter, and indeed the numbers were more than solid. As the results for the first quarter of 2026 showed, net revenues were up almost 27% year over year, from about $1.6 billion to about $2 billion. Which was more than enough to absorb total non-interest expenses increasing from $1.4 billion to $1.8 billion, and still deliver net earnings attributable to shareholders that were up 22% year over year, from $128 million to $156 million. In fact, 2 of their key businesses, investment banking advisory and equity and debt underwriting, as well as equities, delivered first quarter record net revenues. The first quarter results are as of February 28th, 2026. Jefferies is a financial calendar that doesn't align with the calendar year, and all other data in this discussion today are as of the time of this taping, May 12th, 2026. As our regulars know, past performance is not indicative of future results or outcomes, though, and that's where the lively member discussions in our VIP investment club come in. Some really like the high coupons and yields from Jefferies and look at their long-term success in building out their business over the cycles, while others are more concerned about the significant short-term volatility and the inherent uncertainty of investment banking and capital markets as a business model. Now, there isn't necessarily a right or wrong answer here. Everyone's financial journey is different, as we always say. But part of the answer might also be how you would look at Jefferies bonds. And if at this point you want to see how other members and super savers like yourself may be building out their portfolio in a trusted private setting, and not just with corporate bonds, but with other safe, stable, and predictable income sources in the base part of their portfolio, as well as higher yielding assets in the boost part of their portfolio, don't forget to take advantage of our spring sale. Use coupon code INCOME2026 at checkout to get $100 off of a private VIP investment club membership before Sunday, May 17th. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more. I've also linked everything below this video for your convenience. The $100 coupon code INCOME2026 can also be used for a popular bond course bundle. And let's move on now to the next part of today's discussion. Where would Jefferies fit in our Diamond NestEgg Base and Boost strategy for retirement? At the current time, Jefferies is rated BBB by S&P, Baa2 by Moody's, and BBB Plus by Fitch, and all with a stable outlook. Now, these are solid investment grade ratings from all three large agencies, but let's take a look at how we might position Jefferies in the context of our Base and Boost strategy for retirement. So, here are the two key components to a Diamond NestEgg Base and Boost strategy that our regulars will already be familiar with from our recent videos. The base part, this locks in the required income to cover your everyday essential living expenses in retirement. And in our mind, the base part of the strategy should mainly be oriented towards safe, stable, and predictable income that lasts a lifetime. No experiments or unnecessary risk-taking here with the base. The boost part, this should protect you against inflation, help build generational wealth, and or be a source for discretionary spending, whether it's that special night out in town or big vacation, or perhaps a new car for your grandchild or another loved one. The boost part is where you may want to take some controlled risk for possibly higher returns and income, but it may fluctuate over time. So you would not necessarily rely on it for your everyday essential expenses like you would for the base part of your portfolio. So in this context, personally, we would not put Jefferies bonds into the base part of our portfolio for two key reasons. First, these 7% bonds that we've been looking at are callable, starting on May 20th, 2027, so roughly about a year from the time of this taping. The bonds can be called every year thereafter. As we always say, when you buy a callable bond, you need to be prepared for both extremes, that the bond gets called at the first possible date, but also that it doesn't get called at all and will run out its maturity. This uncertainty just defeats the purpose of the base part of the strategy, where you want to build your sleep well at night portfolio that ensures that you will have the necessary income to cover your day-to-day basic living expenses for as long as you live. And second, a BBB rating, solid investment grade as it is not enough for the base part of the portfolio in our mind. When we talk about a guaranteed lifelong income, we think of Social Security, a private or company pension, and annuities from a highly rated insurance company, and maybe long-term treasuries or similarly safe, non-callable bonds. That said, it's different for the boost part of the portfolio, which leads us to the next part of today's discussion. Would Markus and I invest in Jefferies personally? As we touched upon earlier, the boost component is where we think you have the possibility to invest in higher yielding assets that may generate some extra income and potentially keep your portfolio growing. This may give you some protection against rising prices, and perhaps you might even have something left over for the people and nicer things in life that matter most to you. And if you're interested in joining a high-quality private community of like-minded folks and learning more about how everyone is building out their base and boosting the rest of their portfolio, come on over and join the growing member community in our VIP investment club, where these conversations are happening practically every day. Use coupon code INCOME2026 at checkout to get $100 off of our private VIP investment club membership before Sunday, May 17th. There's just a few days left to save. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've also linked everything below this video for your convenience. The $100 coupon code INCOME2026 can also be used for a popular bond course bundle. You might want to take a closer look at the 7% bond from Jefferies if you fall into all of these three categories. 1. You like the coupon. This is probably the main reason to buy for most investors. A 7% cash income yield for a 25-year bond is attractive at the moment. For comparison, the 20 and 30-year Treasury pay about 5%, and the 1-year Treasury, which matches the first possible call date, has an even lower yield of 3.8% at the time of this taping. 2. You're comfortable with Jefferies as a firm and don't mind the volatile nature of the investment banking business they're in. The firm's long-term track record of profitable growth and success in breaking into big investment banking may also help here. 3. You're okay with the BBB investment grade rating and the stable outlook, and don't insist on a rating that starts with an A. On the other hand, bonds from Jefferies might not be for you if you tick even one of these three boxes. First, you cannot live with the callability. The rate is only locked in for the first year, and after May 20th, 2027, Jefferies can call the bond every 12 months at their discretion, which means you don't know in advance whether your money will be tied up for 1 year or 25 years, or somewhere in between. Second, you're buying in a normal taxable brokerage account, live in a high tax state, and don't want to pay your full ordinary income tax rate on the interest. As a reminder, the interest on treasuries and some agencies is exempt from state and local taxes when held in a normal taxable brokerage account. And third, you're looking for inflation protection. While a higher coupon like this one may give you some protection against rising prices, it may not be the most direct hedge. If inflation were to continue to go up, as we've seen recently with rising oil prices while the Strait of Hormuz remains closed, and the Fed started to raise rates to fight it, Jefferies, as the bond issuer, would probably have no incentive to call a bond that may now have a lower coupon than new issues at that point, which means that in such a scenario, you might be locked into a below market rate or have to sell at a loss. So, if inflation protection is a top concern for you, you may consider real assets or have a look at TIPS and our I bonds instead. And for our VIP Investment Club members, we will be talking more about this in our upcoming Member Live this month. And for those of you who want to join our lively discussions about all things money, investing, and retirement, remember to visit our website at www.diamondnestegg.com and use coupon code INCOME2026 to get $100 off our private VIP Investment Club membership and bond courses. So personally, Markus and I do like the coupon on this Jefferies bond, and we can get comfortable with its callability. So if we were a bit older and looking to move more of our money into longer dated bonds for a higher income stream, this is one we would invest in as part of our Boost portfolio. But then again, both of us grew up in investment banking and financial services and feel generally comfortable with this somewhat special industry. Your circumstances, goals, and expectations may be different. In case you want to dig deeper into this Jefferies bond for your portfolio so that you can decide for yourself, here's the QSIP, 47233WMP1. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very, very soon with more brand new wealth building content for your financial journey.